Liability insurance is third-party insurance, which means it protects a policyholder from claims by third parties. Sometimes claims are dismissed or go away. Other times the claims settle or result in a judgment against the policyholder. In this lesson, we'll look at the parties' obligations for claim settlements and the insurer's duty to indemnify the policyholder for the cost of paying settlements and judgments. Imagine a furniture manufacturer was sued by a class of consumers. The consumers alleged the furniture contained toxins that had caused property damage and bodily injury. The manufacturer had a commercial general liability, or CGL policy, with $10 million limits. The class offered to settle the lawsuit for $10 million. The manufacturer believed a court judgment could reach $30 million and wanted to settle. The insurer was already at its maximum coverage obligation and figured there was a small chance of a lower judgment or that the manufacturer would win. Thus, the insurer wanted to reject the settlement. Was the insurer allowed to reject it? In a settlement situation, CGL policies usually give insurers the right to settle claims for an amount within the policy's limits without necessarily getting the policyholder's consent. But what if the insurer wants to reject a settlement offer? An insurer's settlement behavior is governed by the reasonable insurer without limits test. This means the insurer must act the way a reasonable insurer would act if the policy had no limits or provided infinite coverage. For instance, if a reasonable insurer would reject the class's $10 million offer even if the insurer had unlimited policy coverage, then the manufacturer's insurer may reject the offer. But if a reasonable insurer with unlimited policy coverage would accept that offer to avoid a likely higher verdict, then the insurer is obligated to accept the settlement offer.